Thank you all for joining us today on this webinar. Uh, we will be talking, without much ado, we will be beginning the webinar shortly. So, over the past month and a half, we've seen that the capital markets have been collapsing. Now, there a lot of the reason for the major reason for the decline in the crash in the stock market as well as the bond market has more to do with macroeconomics rather than something that we can control here. So, in this edition of the webinar, we will be looking at the global economy, we'll be looking at the Indian economy, and then we will eventually be arriving at the investment strategy. Start off with the European Union. The GDP numbers of most of the world was released in the previous month. So we will be looking at the GDP, the economic performance of each of the economies based on the GDP, as well as the PMI and some of the key indicating factors. The GDP of the European Union for the quarter that ended in December 2017 grew at about 0.6%. And similarly, the GDP of the United Kingdom, which is currently in the process of exiting the European Union, stood at 0.4% for the same period. The economic indicators, as measured on the left side of the screen, that is mainly inflation and unemployment rate, show that the inflation, which was a bit high in December, came down slightly in January. A key factor for this is oil. And we will be looking at oil as the commodity section subsequently. But the key cause of concern over here is the inflation. Inflation for developed economies typically should be at about 2%. But as you can see for the European Union, it stands at about 1.7 and 1.7% in December and 1.6% for Jan. The European Union the European Central Bank is currently purchasing about 30 billion euros worth of bonds in a month in the financial markets to keep the lid on borrowing costs. And these purchases are expected to run until the end of September or maybe beyond if necessary. And this entirely depends on the inflation. What this means is that unless the inflation is able to sustain itself, that is, if it hits a 2% mark, the European Central Bank will continue buying bonds so that it can pump in more liquid cash into the economy. So what additionally happens over here is the inflation gets affected due to a different factor altogether. In the last couple of weeks, we've heard comments from key members of the United States administration suggesting trade wars. For example, the US Treasury Secretary Steve Mnuchin claimed that a weak dollar is good for the American economy. What this means is the American economy is trying to weaken its dollar so that it can become much more competitive in terms of exports. We also had US President Trump saying that he would be imposing taxes on aluminum and steel imports, except for those from Canada and in Mexico. What this would make the global imports, how this would affect the global imports is that, if you look at European Union and China, they have manufacturing capabilities and competencies against the United States. So a U.S. U.S. consumer of these metals, like for example Harley Davidson or any of the other the automobile companies, they'd be better off in importing steel from China or maybe the European Union. But with the imposition of the tax, the cost of importing metal from China and Europe goes up. And consequently, there is an additional increment in the availability of these metals in China and the European Union itself, for example. In turn, what will happen is this will create a surplus of available capacity and surplus available raw materials, Thereby, the inflation, which is expected to go to 2%, might not actually hit the target. While while the Trump administration has gone ahead with imposing with the proposal to impose the taxes on imported aluminum and steel, there were also remarks that Trump had made that he would not be pursuing a weak dollar policy, but rather a strong dollar policy. So the euro versus the US dollar keeps the euro trading at somewhere about 1.23 to the dollar. But if you look at the other factors, such as the unemployment rate, they have held steady. The unemployment rate in the European Union and United Kingdom are are are, are at much lower levels compared to what they were about a decade ago before the financial crisis hit. But that said, there is still a problem with the youth unemployment that is plaguing some of the parts of the European Union, like for example Spain. The activity, as measured by PMI, suggests that the European Union, as well as the European Union economy, is expanding quite rapidly. A lot of this is thanks to the bond buying measures, which is undertaken by the European Central Bank. The PMI, if it reads over 50, means that the activity is expanding, and further it is from 50, it means a much more stronger and rapid growth. So, as can be seen on the right side of the screen, the manufacturing PMI for the month of January 2018 stood at 59.6, which is a very, very strong growth. But however, in February, it declined a bit to 15.6. Well, in terms of the PMI absolute numbers, it looks like it has dropped. What this really means is that the growth has not been as fast, but the growth is still very rapid. Now, if you look at the United States, the country which could potentially bring back the deflation across the world, if you look at the core inflation, for the month of January, it stood up at about 1.8%. While the official statistics are not yet out, it is expected that the inflation for the month of February will be about 1.83%. And the wage growth, which is the key driver for inflation, is expected to have grown by about 2.8% on a year-on-year basis. This compared to 2.8% in January 2018. Jobs are continuing to be added by the US economy. In the month of February, we had about 205,000 jobs added, and unemployment rate has declined from the 4.1% in January to 4% in February 2018. And this is almost a two-decade low. The GDP expanded by 2.5% in the last 3 months of 2017. That is in the quarter that ended in December 2017. But it looks like this growth may not sustain. So if you look at the previous the expansion of the GDP in the third quarter, it hold about 3.2%, whereas in the fourth quarter it's declined about 2.5%. It shows that the U.S. economy is still a bit weakening. And if you look at some of the data which was released in the beginning of the year, it looks like the economy has lost some more momentum. It suggests that retail sales, home sales, durable goods, and other industrial production has actually declined in January. In addition to this, the goods trade deficit widened last month as exports actually fell. And this despite some of the countries lowering the duties for US goods. And this in turn can be mapped to what the US Treasury Secretary said, which we discussed in the previous slide, that he would like to pursue a weak dollar policy so that US can actually export much more. but the U.S. President Trump has suggested a strong dollar. So the U.S. exports will continue to be a bit, it will continue to be a bit tepid. Now, with uh, the U.S. President stating that he will be indulging in trade wars, we will likely see a further decline in U.S. exports because the U.S., which will be raising tariffs on some of the steel, can also expect reciprocation from some of the other economies. For example, we had not too long ago we had uh, head of the European Union, so Jean-Claude Juncker, stating that he will also be raising tariffs on uh, some of the goods that will be imported from the United States, like for example the Harley Davidsons. While stating this, he also stated that this is necessary to bring back to maintain uh, uh, uniformity in trade rather than having a sort of a disadvantage. With that said, look at some of the other factors that have been that can be measured in the United States in itself. We look at the PMI. We look at the services PMI. It's actually picked up from the month of January to February. What was 153.3 in Jan is up to 55.9, and this in turn is driving up the composite PMI. The PMI indicator suggests that the US economy is growing. But however, the sustenance of this growth can must still be excuse me. The sustenance of this growth is still a bit. Uh, it depends on multiple factors at the moment. If you look at the US is one of the largest trading partners with Japan. And Japan is the third largest economy in the world. The unemployment rate of Japan has dropped dramatically from 2.8% in December to 2.4% in January. There was a slight uptick in the month of December uh, in terms of unemployment, where we had the unemployment reading for the month of November starting at 2.7%. So it looks like Japan is creating quite a lot of jobs. But with the aging demographic, it would look like they would depend on some of the uh, international talent to help drive their own economy. So in a statement quite recently, uh, Japan has stated that they would be opening up jobs for about up to about 200,000. That's about 2 lakh IT professionals from India. So this will actually help drive up their services PMI. Manufacturing PMI, which you can see at the right side, it's been the manufacturing PMI of 54.8 is good, and so is reading of 54.1. It suggests a rapid expansion. Although it shows a slight marginal decline in the PMI reading, it's still a positive note for Japan. So the overall composite PMI for Japan is 52.2. The services comprise about 60% of the Japanese economy. With an expanding services PMI, it actually bodes well for the Japanese economy in terms of expansion. So that's why if you look at the GDP growth for the previous quarter, it stood at about 0.5%. Japan's economy grew at a slower rate than expected in the October to December quarter. The exports were not exactly strong enough to compensate for the weak domestic demand. And if you look at some of the data released by the Japanese board, we will see that the Japan has managed 8 straight quarters of GDP. It's the longest expansion of the Japanese economy since the bubble it experienced in the 1990s. And a lot of this is thanks to the aggressive financial measures taken up by the Prime Minister as well as the Bank of Japan. The Bank of Japan has been infusing about trillions of yen or billions of dollars of cash into the economy through through asset purchases, mostly government bonds, to counter deflation. This is a tactic which is very similar to what the European Central Bank is employing, which we had discussed in the previous section. Now, this has encouraged investment by keeping the costs of borrowing low. But however, the Bank of Japan maintains a negative interest rate that is at minus 0.1%. So, what this would mean is that the Bank of Japan is actually paying the economy to grow. There has been a rebound in exports in the recent months, and this is primarily due to a stronger China. Now, regards to what will happen in the future, we'll, the Japanese economy it's still quite export dependent, and and although for 60% of the Japanese economy depends on services, it also is heavily export dependent. Now, with the yen weakening uh, globally, exports will pick up. However, with the US imposing tariffs on imports of goods, it might actually affect the Japanese economy. Now, if the US is moved to indulge in trade wars, actually does invoke reciprocation from across the world trade itself will actually be affected, and not just the and if the world trade is affected, the Japanese economy will also take a hit. So when we look at the Japanese neighborhood, if you look at the Asia Pacific region, Asia Pacific region is primarily dominated by the Chinese economy, the world's second largest economy. The Chinese economy had experienced GDP growth of 6.8% in the quarter that ended in December. This was and this was a very similar reading to what the Chinese economy had experienced in the third quarter, that is the quarter that ended in September. In both Q3 and Q4 of year 2017, the Chinese economy grew by 6.8%. In Q3 of 2017, the Chinese economy grew by 6.8% and was the fastest growing economy for that particular quarter. The Chinese economy has been undergoing a process of shifting from a manufacturing and investment driven economy to a more consumption driven economy, and that has actually helped the Chinese economy boom. But that said, it also has increased the amount of debt taking in the Chinese economy, with almost about 300% of the Chinese GDP is outstanding debt that it has. With that said, China has better than expected economic growth in the previous quarter at about 6.8%. Was supported primarily by the growth in the services industry and an expanding agricultural sector. The services sector has accounted for almost half of the GDP in the quarter by value, and agriculture has contributed about 10%. That means about 60% of the Chinese economy did not come from manufacturing and primary sources. Now, with the strengthening of China, the region itself does prosper due to very strong trade relations within the area. So, as we had seen in the previous section, because of strengthening China, Japan was able to improve exports. And it's not just Japan which is benefited from this; it's also the Southeast Asian economies which benefit. The Southeast Asia's PMI as for manufacturing stood at 50.2 for Jan 2018. This has expanded marginally to 50.7. This is on the back of improving trade within the region. Now, the Asia Pacific region primarily is a more manufacturing dependent, and the biggest supplier is the Latin American economy. So, when Asia Pacific economy expands, So does a Latin American economy. The GDP of Brazil grew by about 2.1% on an annualized basis in the previous quarter. This is a bit weak. However, considering the fact that Brazil was in a recession until the beginning of 2017, this is quite a success. Economic activity, as measured by PMI in Brazil, uh, it's, indicates quite a strong recovery. So, in the month of January, we had the services starting at about 50.0, but in the months before that, it was in the red with a reading of less than 50. But if you look at the PMI for the month of February 2018, the services PMI has actually picked up for Brazil, starting at 52.7. And manufacturing has been the primary driver of economic activity for a brief while. And this stood at about 53.2 for the month of February. Overall, the composite PMI of Brazil has grown from 50.7 in Jan to 53.1 in February. This is quite this suggests that the Brazil's economy, which has a multi-year low inflation, a multi-year low central bank interest rate, uh, is actually back on the track of expanding. But what would actually be detrimental to the sustenance of this growth is the outcome of the Brazilian elections. Mexico, which has a very large exposure to the U.S. economy, is one of the two countries which may not experience a trade tariff under Donald Trump's early proposed system of imposing taxes on importing aluminum and steel. The manufacturing of Brazil had expanded at 52.6 on the PMI scale for the month of January. And further, there was a slow expansion in the month of February to 51.6. Now, uh, when we look at India, services is India's biggest driver. And in the month of February, services has declined. While India's GDP grew by 7.2% in the quarter of that ended in December, uh, this was uh, this was a reflection of the Indian economy adopting the changes of the GST as well as overcoming the shock of the demonetization. But the services in the service activity in the month of February had contracted for the first time since November. And this was primarily due to rising inflation. So in the past 2 months, we have seen inflation going over the 5% mark, as measured by the CPI, as can be seen on the left. The Reserve Bank of India would like to keep the inflation at 4%, plus or minus 2%. While 4% is the ideal target it would have, anything lower than the 2% mark will prompt the RBI to lower interest rates further. Lowering of interest rates will prompt further investment. But with inflation being this high, as well as the government picking up spending, plus with the rising crude oil prices over the past 2 quarters, inflation may not quite lower for a brief period to the less than the 2% mark. There are a few upside risks to the inflation, but they seem to be limited for the next couple of months. But if you look at the other indicator of the PMI, which is primarily manufacturing, manufacturing has been has seen a good amount of growth. It has seen sustained growth and has been detrimental to the revival in the economy. Now, close look at the India's GDP growth it shows that the consumption demand is actually decelerating, and this can also be seen in the PMI, which we had seen in the previous section. We've seen that the PMI was in the red for in November. It expanded in December and January, but is once again declining uh, for the month of February. So while consumption is declining, the government is actually picking up investments. So the government has seen an alternative way to pick up investment through debt while uh, while not affecting its current account deficit. Now, because of this picking up of investment by the government, we can actually see that the GDP is also rising, as can be seen on the right side of the screen. Now, further growth will be subject to how much the private investment also picks up. While the government investment will drive growth in infrastructure, it also will spur the inflation. And if inflation rises, the RBI will raise interest rates. If RBI raises interest rates, private investment and consumption will both decline. So a lot will depend on how much the private sector of India will actually be helping in picking up of the investments. Now, the biggest factor for investment for inflation in India is oil. Oil prices had risen all the way to a level of about had reached a $66 mark sometime around mid-January, but it has been on the decline since then. The oil markets primarily depend on two or three primary factors. One would be the U.S. oil inventory and Chinese demand. Second would be the oil production, and this primarily is dominated by OPEC, that is the Organization of Petroleum Exporting Countries, uh, along with Russia. Now, with the U.S. Production of oil picking up, the prices of oil, as measured, that is seen with the WTI, had declined from the $66 mark, as in mid-January, to the $59 mark. But there was a revival in the world demand as such for oil, and with the OPEC continuing to reduce production, there's been this decline in oil prices was just short-lived. Now, with the US dollar strengthening, crude oil, just like any other commodity, would start declining. So, as can be seen on the graph on the right side, uh, we can see that the oil prices had picked up for the month for 23rd February, and this has declined since then. And similar to oil, another commodity of interest that has also seen a decline due to strengthening dollar is, excuse me. Another commodity that has seen a decline in strength is gold. Gold had also weakened due to the strengthening of the US dollar. And there continues to be some bit of uncertainty in the world due to the trade wars made by President Donald Trump. Gold reacts sharply to the US dollar. So, recently, when the Federal Reserve's chair, Mr. Jerome Powell, he said that the Federal Reserve is expected to raise interest rates three times in this year, and This is to promote employment as well as to control inflation. When the US inflation rises, the US dollar weakens, and consequently, we will also be looking at the gold strengthening. One of the key aims of the federal chair is to deflect, is to deal with the US's very large debts. And recently, President Donald Trump had announced a $1.5 trillion cuts in taxes and in income inequality. Uh, the markets are badly were not exactly uh, welcoming this particular change, and but they weren't unwelcoming of the change either. So the markets badly moved because of this particular event. So there is a bit of a uncertainty coming in the US itself. Now, because of this uncertainty, we can actually expect the US dollar to weaken maybe a little bit. So both crude oil as well as gold will can be expected to rally in the coming weeks. Again, all of this we arrive at an investment strategy. Donald Trump's comments on imposing uh, on the imposing of trade tariffs for to introduce a trade war will actually keep the world markets volatile. But India has already started. The government of India has already started investing to boost the GDP growth. As ca- uh, so, with the growing GDP as well as picking up in infrastructure, the stock markets can be expected to rally in the longer duration. But the short term still does look quite volatile. So it will be best to stay invested rather than to trade at this particular point. For those who would be looking to enter the market at this point, investing through an SIP would be beneficial to help tide over the volatility. Now, with the government picking up infrastructure, it'll investments in infrastructure as well. It will be looking to raise debt. When it raises debt, uh, with the already rising inflation and the already abundant government of India bonds available in the market, the securities of the government of India issued in the markets will actually weaken due to an extra supply. Further, with the rising inflation, the yields of these bonds are also expected to rise. Yields and the price of bonds have an inverse relation. So, with the rising inflation and the picking up of the government of India's debt, bonds of longer duration will actually weaken. So, it would be best to invest in bonds of medium and shorter duration. Medium and shorter duration bonds will actually help stabilize the portfolio. Gold will continue to shine in times of volatility, and with volatility happening across the world, with the elections in Italy, uh, with President Donald Trump, there is a lot of uncertainty coming up ahead, and during such times, we can actually expect the stock markets to crash. But the inverse of that is the gold, which will actually rise. So it will be best to keep about 5 to 10% of the portfolio in gold to help tide over the downside losses. With this, we reach the end of our webinar. We are now open to questions. We do have a few questions regarding the US specifically. There are a few reports that say the Federal Reserve will increase interest rates about 4 times this year. So, yeah, if you look at the indicators which we saw in the US section, we saw that the US economy is actually losing a bit of steam. When it actually loses a bit of steam, the inflation will also actually decline. And when it does decline, we can actually expect the Federal Reserve to not raise interest rates. But initial reading suggests that the U.S. Economy is going on track. So this is more of a continuation of where Janet Yellen had left off in the previous year. So the current chair, Mr. Jerome Powell, will continue to follow the same policy as Janet Yellen, and most likely maintain the a three-time is expected to raise interest rates only three times this year rather than four times. There's another question of on the effect of a tariff on aluminum and steel by the United States. So countries that export aluminum and steel to the United States will be experiencing will be levied about 10%, 25% tax respectively. So what will happen is the amount of imports that the US will be making will actually go down, specifically to these two. And when the export of these goes down, there'll be a surplus of steel and aluminum in the markets, which means that these metals will actually see a bit of a decline. That is one effect. Second, because of the decline of aluminum and steel, the input prices or the input inflation of production houses will also decline. So we can actually expect that the overall inflation, which will be passed on to the end consumers, will also decline. So this in turn will mean that the inflation of United States will also may not be able to sustain. Third, the effect of the tariffs can also receive reciprocation. So, as we had discussed in the European Union section, Jean-Claude Juncker of the European Union is also looking at imposing tariffs on some of the goods imported from the United States. So, what that will mean is this will reduce overall global trade. And when it reduces overall global trade, the world itself is at a loss. More question regarding Donald Trump meeting the North Korean leader. Will it bring global stability? The last year has suggested that the entire North Korea versus US relations has been quite unpredictable. There were a lot of war of words traded between North Korea and the United States. So, with the US and North Korea willing to have talks, there could be chances of stability, specifically in the international relations between USA and the Asia Pacific region. But that said, what matters is more the outcome of the talks rather than the talks in itself. So if the talks do actually not go well, we can actually see a resumption of the war of words that was traded between the US and the North Korea. Question regarding why is private consumption demand decreasing and will it continue to decrease? In India, the private consumption is primarily driven by prices of one very important commodity, which is oil. Because of oil, there's been an inflation of prices that's not primarily due to consumption. So if you look at, if we have, unfortunately, I'm not able to present the screen right now, but if you look at the private consumption, as we had seen in the India's GDP, versus the price of oil, which we had seen in the previous section, you would see that there is a sort of an inverse relation between the two. So because of the rising oil prices, the consumption of the end consumer itself actually does decline. And when the consumption of the end consumer declines, the overall sentiment of buying or investing will also decline. This was also a similar case which we had seen in 2013 or so, when oil prices were almost like $100, but private consumption was actually much lower in India. the same time, we also had high inflation at the same point. Do you have any more questions? Thanks for participating in our webinar. We really appreciate your active participation in this webinar, and we look forward to hosting you once again next time. Feel free to reach out to us if you have any questions regarding the economy or investments at research@ArthaYantra.com. We have a question regarding should the investment be kept there as Lens Top 200 fund. We do not know your specific personal financial details, so we are not in a position to exactly tell you what should be your the call you could take on this. So we suggest you would have a conversation with your financial planner, because they would be in a much better position to recommend these to you than me. Any more questions? Thank you so much for participating. We look forward to hosting you once again soon. We will be sharing the recording of this webinar with you shortly this week. Thank you.